On Bitcoin, what did we learn this week? I put up there some of the dynamics, the silliness of it being a gold equivalent or a coin equivalent. What did we learn?
I think we got reaffirmation that it's a speculative asset and it still has a long ways to go to become a gold equivalent, to become a proper storehold of wealth, something that you can count on to have purchasing power over time that's going to have stable and relatively low volatility. This was not a low volatility week or so for Bitcoin, quite the contrary.
Rebecca, do you see a generational divide between certain age groups who believe this is the new gold and other age groups that just do not?
Anecdotally, yes. Anecdotally, it does seem that people who are looking for alternative sources of cash, if you will, you do have a bit of a younger generation bias towards the cryptocurrencies versus gold. But to me, it's not the generation as much as the retail versus the institutional. The money that's going into Bitcoin and other cryptocurrencies today is still largely retail. Of course, you're getting a few more corporations, you're getting family offices, you're getting some hedge funds, but the large institutional money that's thinking about, do I want this as part of the diversifying assets in my portfolio to protect me from drawdowns, from bad periods of market stress? We're not there yet. It might get there over time, but it's not there yet. So this is still an asset that I think is primarily one to be used for return and speculation.
Over time, though, Rebecca, do you think that investor conditioning kicks in? Many people will ask us when they're not familiar with financial markets and macro, why does the yen do so well when things get bad? And there are various ways of explaining that, but one of them is it just does well. It's worked, and it's worked historically. Do we need to be conditioned by this somehow to start believing it a little bit more?
Well, I think over time, you could see that environment come together. And there's a couple things I'd be watching. The big one right now is the regulatory ecosystem. It's very immature still for cryptocurrencies. And after the Colonial Pipeline hack paid for with crypto, the ransom was paid for crypto, I think you are going to see regulators in the US focusing more on this, trying to make sure there isn't illicit activity, trying to increase transparency. That might make some holders of Bitcoin not want to own it anymore. They're there for the anonymity, but it could create an ecosystem that gives more credibility to it, more encouragement for large institutional players to come in. If they come in and you have another source of liquidity there, that could bring down volatility over time. That's the positive flywheel that I think could change how Bitcoin and perhaps other cryptocurrencies are perceived. Obviously, there's the environmental issues too, which are clearly a problem for some investors. I think those things need to get addressed and the volatility needs to come down. But if those things can happen, I think this could evolve into some type of digital gold, if you will.
Rebecca, I want you to elaborate on the environmental concerns because Elon Musk of Tesla highlighted this, and you highlighted this in a recent research report showing that Bitcoin uses up more energy than, say, even Switzerland. When you take a look at the energy consumption, it's basically a nation unto itself when it comes to this area. Can this be solved? How big of a concern is this for certain investors?
Well, increasingly, investors are focusing on environmental and other ESG issues. So it is an increasing concern for a lot of large institutions. There are ways it can be addressed. You can see changes in the technology used in Bitcoin, for example, that could reduce energy usage. You could see the type of energy used, more of a focus on renewable energy. That could also be a positive trend. There's also another option here, which is that another cryptocurrency that has lower energy usage, but also some of the positive characteristics like limited supply, you could see that supplant Bitcoin. Just because Bitcoin is the dominant currency today doesn't mean it'll always be. So I think there are some different paths, but over time, it's going to get addressed one way or another.
Meanwhile, Rebecca, I want to pick up on something that John was talking about, because I know that this dovetails into the inflation call that Bridgewater has had, this whole cash is trash and that Ray Dalio was talking about. But moving forward, that inflation is going to be more of a threat. What do you make of the move recently lower in longer-term break-even rates? Basically, longer-term inflation expectations have come down, even as we get this robust data.
Yeah, I mean, this is such an unusual time, right? We're seeing the biggest U.S. boom that we've had in decades, and we have so many different cross currents given the reopenings coming out of the pandemic, demand rising faster than some supply can meet it. And you just mentioned that a few minutes ago in the European PMI data, that it's hard to have a high degree of confidence how this is going to play out. But as we look at the year or so ahead, we see a decent amount of risk that inflation could keep rising. It's already rising, but stay higher for longer. And part of that is the supply taking a while to catch up with the increasing demand. And part of it is more structural forces. Globalization, which has helped reduce inflation for years, that's been plateauing and could possibly reverse a little bit. The trend towards capital over labor, that's starting to reverse a little bit as you see higher wages, higher minimum wages, et cetera. And so if you see some of these secular forces slowing or reversing somewhat, and these cyclical forces, we think you could be in a slightly higher inflation environment. So the day-to-day moves aside, I think you want to be looking as an investor, does my portfolio have enough protection if that risk becomes reality? And this isn't just, as the Fed likes to say, transitory inflation.
Rebecca, I want to get in trouble with Ray Dalio, so I'm going to ask a rude question, and you're such a pro, you'll give me an honest answer. Right now, stock-bond correlations are really quite odd. That goes into rate parity strategies and such. What is the duration, the timeline of this odd correlation where it begins to affect portfolios? We're hearing short-term, no big deal. When does no big deal become a big deal?
So, Tom, I don't think that's a rude question at all. I think you're highlighting a couple things that are worth unpacking a little bit. First, when we think about risk parity strategies, all weather, which is our strategy, it's a strategic long-term asset allocation. What we're trying to do is get rid of some of the volatility that can come with changes in economic environments, growth, inflation. And what that allows us to do is get more steady returns over time. And then we can compound that, which is, as Einstein said, isn't it the eighth wonder of the world? So that's a very different strategy than, say, pure alpha, where we're really focusing on uncorrelated return streams that are over shorter time periods. It's more tactical. For folks who are thinking about a risk parity strategy, remember, it's never been determined on one asset or one country. It's going to be a balanced mix of assets. So even if bond yields rise, there are going to be other bonds that are still attractive. China, for example, the 10-year yield there is still 3%, much more normal policy mix going on. And then you're going to have other assets that are going to give you that diversification and that balance, no matter what the environment is. But the other thing, Tom, that I think is really important that you just said is about correlation. And I think, every 60-40 portfolios over the last couple of decades have just been able to sit back and let it roll in. You've had rising stocks and falling bond yields. And today there is a chance that you're going to see that relationship break apart. And you need to understand why that's happening and then what you do about it. If we think that relationship is breaking apart in part because of inflation, then you want to make sure that you don't have too many bonds. You want to make sure that you also have other assets to protect you against that risk, whether it's gold, which has been recovering nicely recently, inflation-linked bonds, even equities that give you more of a steady cash flow over time that aren't going to be as vulnerable to that duration issue.